Welcome to Tav's 2 Cents, a show for average Joe investors where we talk finance and how to achieve success.
Hi, welcome to Tav's 2 Cents, the show where we talk about business, finance, and achieving success. Today on the show, we have Peter Sainsbury. Peter is an author of many books, including Commodities, 50 Things You Really Need to Know, and he is the producer and writer for the Carbon Risk Substack. Hope you enjoy the show. Thanks. Peter, welcome to the show.
Thanks, Jay. Thanks for inviting me.
Yeah, no problem. So I thought we could start the show if you'd want to just provide an introduction for the listeners or viewers as to your history and what inspired you to start Carbon Risk.
Yeah, that's right. So my name's Peter Sainsbury. So previously, my background is as an economist. So I worked for over a dozen years for an environmental NGO based here in the UK, and that was very much to do with like environmental markets and helping companies and governments with their environmental policy. And then before that, I worked as an analyst for an oil market consultancy. And during that whole period, I was kind of very much involved with commodities, both as an investor and producing my own content. So I've got a separate website called Materials Risk, which is my kind of conduit to sort of delve into some of those issues that I see in the world of commodities and macro more broadly. But then really, it's probably almost a year ago, I left my the full-time job and had been started work on another book. So one thing I haven't mentioned is the last sort of 5 years I've written and published about 4 books. Everything to do with commodities, commodity markets, misinformation in the media, and also betting on Formula One. So quite a difference of topics there. But yeah, so I left my job to write. So that book's is made good progress. But then when it came to November last year, I was kind of getting a little bit. I guess it was all becoming a bit too much, and I had to take a break from it. And but then in doing that and in writing the book, I kind of realized what the actual opportunity was for me in terms of writing and from an investment perspective. And that was really to focus on carbon, carbon markets. And that's really where we've got to today, really, is I launched a newsletter on Substack called Carbon Risk back in November. And then since then I've been churning out sort of 4 or 5 articles a week on how investors should kind of navigate these markets, both the formal compliance markets like the EU ETS, but also what people need to look at in terms of like the voluntary carbon market. Because I think there's certainly quite a lot of confusion about the different types of markets and what the potential opportunities are.
That's great. So why don't we start from the start with that? Because that's really what I want to talk to you about is carbon markets, carbon credits, EU ETS, all that great stuff. So what is a carbon credit?
Yeah, I think there's a distinction between carbon allowances. So this is almost a permit to pollute or to emit a ton of carbon dioxide, and that's what you get on these formal compliance markets. So the EU ETS. There's markets in California, Northeast America, and then a few elsewhere around the world, including like China and New Zealand. So those are formal regulated markets. So they're very different from the voluntary market, which, as the name suggests, is completely voluntary. It's companies that you might have heard, you hear in the news, like say Microsoft or Exxon, that they've committed to reducing their emissions or going to net zero at some point in the future. And in committing to do that, they've looked to offset some of the carbon as part of their company by purchasing carbon credits, based on projects elsewhere in the world. So these carbon credits could be sort of nature-based carbon credits, so like reforestation of an area that's previously been cleared, or it could be kind of technology-based credits where carbon is captured from the atmosphere and locked into things like concrete or other technologies that can hold that carbon for a long period of time. But that comes with a lot of risk and uncertainty, really, because there's such a varying degree of quality. So you've got to, the ideal standard is they've got to be kind of real, measurable, additional, so that they wouldn't have happened otherwise. And they've got to really know that that carbon is locked in for a long period of time. So you don't just want to buy a credit related to a piece of, say an area of forest, but then a year's time, there's a fire and it all burns down and all that carbon's released back into the atmosphere. So it's there's a whole sort of sway of different credits, and that's kind of reflected in the price that people pay for these credits. On the low side, or perhaps the average is around maybe $5 to $10 a ton for these credits, but they stretch from cents per ton for very poor quality projects to $50 and above for very high quality projects. That's that kind of voluntary market describes what sort of corporates are doing, what companies are doing, and also might describe what some of your viewers or listeners might be doing with, if they take a flight, they might decide to offset the carbon emitted from that flight by purchasing credits. But there's also a third potential market for these voluntary or for these carbon credits, and that's governments. So over the last 10, 20 years, governments have committed to cutting their emissions, approaching net zero. And up until recently, it's very difficult for them to, they had to almost do everything within their own country. But from the climate conference last year, COP26, regulations have been put into place that now are approaching a point which enable governments to actually buy offsets from other countries. And the reason why this is good from a climate perspective is it potentially reduces the cost of cutting emissions, and it also presents potentially for investors is a massive market that could potentially grow. The corporate market is maybe about 100 million tons at the moment, but the government market could be multiple times bigger than that in the future.
Yeah, it's really interesting, the developments that came out of COP26, especially when you talk about international markets and Article 6 and what they've done there. And that's actually something I wanted to ask you about is how do you think that's going to affect carbon pricing? Because in Canada, for example, we've got mandated by law $170 carbon by 2030. And then I know in Germany, they've had a 60 euro base. They just started they wanted to do a bottom of $60 in their market. So I don't know how these are going to all float around internationally. What do you think?
Yeah, that's right. So it's encouraging in one sense that you've got countries committing to carbon taxes. So that to some extent that might just focus on particular sectors, these taxes, whereas some countries like you might use emissions trading to put a price on other parts of the economy. The problem with taxes is that it's a government price. So someone, a civil servant, has said $60 a ton or whatever is a viable price to incentivize decarbonisation. Well, on the other hand, I certainly believe that markets, through emissions trading, is a much more effective way of putting a price on the cost of that externality. The other thing to think about is that you've got a lot of different approaches everywhere around the world, and what that might mean is you get industries moving to places where the cost of carbon, either through taxes or emissions trading, is lower. So it's a problem known as carbon leakage, where industries might decide not to invest in Europe, for example, and they decide to invest somewhere else where the cost of that carbon commitment is much lower. So what you really want to get, I think it will come to this in the next sort of 10, 20 years, is a kind of a global carbon price. At the moment you've got lots of different competing politics, different places around the world, even within certain countries. But I think as countries start to put border taxes around their regions or around their countries to kind of protect low carbon or products that haven't been subject to a carbon tax from entering their countries, then I think that will increasingly put pressure on other governments to introduce carbon pricing as well. So I think we're still at a very early stage in how these markets are developing, and I think as that political pressure grows, there'll be more and more different markets emerging around the world.
Yeah, that's definitely something that I've wondered about because here in Canada, our province, Quebec, is linked with the California market. So
Yes.
they trade within each other, and it's, the more markets that continue to link with each other, then you're just sharing the same. And we're talking about mandatory markets, but
Yeah.
they're just trading the same credits between each other, and that whatever the price is, that's what it is for
Yeah.
those. But just moving over to voluntary markets for a minute, what do you think about ESG trends coming up with investors and how that's going to affect companies, especially if they need to start showing carbon emissions on their balance sheets?
Yeah. So I mean, I think in terms of emissions, formal emission allowances, as you get in the EU ETS and the carbon market, the California market, they can be assets on a balance sheet, so companies can treat them that way. And increasingly, I think you're getting companies who actually recognize that their carbon commitment is going to go up in price in the future, so they're actually buying more allowances now than they need just to put them on their balance sheet for the future. But then, I think if you think about the financial opportunity involved with ESG investing, there's the cost of the commodities that go into producing like a windmill. There might be other kind of incentives around providing renewable energy, but there's also the carbon cost, either the avoided carbon cost that, by supplying that renewable energy. So that's something for, I think companies will increasingly factor that carbon cost into their investment opportunity.
Yeah, I've seen lots of companies who have started to come out with carbon pricing programs,
Yeah.
and they have, for whatever reason, they have either reduced their own emissions or they have provided a service to other companies where they can reduce their emissions. And as a result, they can get carbon credits in return. And I wanted to ask, which industry do you think will be a leader, at least in the early stages, for carbon credits? Because I think for me, I see industries like oil and gas, and everybody thinks, oh, those are dirty industries, but they have a lot of room to cut back. So then they can, based on their allowances, they could earn some credits.
Yeah, and I think that's a good point, because I think where it's really sort of starting to take off at the moment is in the LNG market. So particularly in places like Japan and Southeast Asia, there's they rely heavily on natural gas, and anything they can show that gas is carbon neutral, people are willing to pay a premium for. So we're starting to see, I think it was something like 20 to 30 LNG cargoes in the past year or two have been sold as carbon neutral. And I think, as you say, increasingly companies like, I think recently Exxon, committed to net zero, and carbon credits were part of that, the way they were going to try and meet that commitment. I think it comes back partly down to quality. Are those genuine offsets? And I think the other thing to bear in mind is, what is the scope of those emissions that they're looking to offset? Is it just the emissions within their supply chain, or things that they can actually control, or is it the actual scope 3 being the downstream emissions by the actual users that they're looking to offset as well? It's good because for an energy company, those scope 3 emissions can be so much bigger than the actual scope 1 and scope 2 emissions. So I think that's something for investors to be really aware of when they see energy companies make these commitments.
Yeah, the distinction between net neutral and net zero. I wonder if you could talk about that.
Yeah, so I mean, it really kind of comes down to how they're, kind of the definition of what they're looking to achieve, whether it's this kind of within their own supply chain. Are they looking to actually just offset their emissions, or are they actually looking to reduce their emissions that they can control to to zero or very close to it? So I think it's that there's so many different definitions going around, and I think there's an element of confusion, I think, among both investors and the wider public about what actually companies are actually committing to do.
Yeah, they really need to make it clear when they say we're going to be net neutral or net zero, that we're going to be net zero scope 3 emissions, or we're going to be net zero scope 2. But even then, it still gets complicated. There's a few visualizations out there that kind of clears things up for people when they talk about scope 1, 2, and 3 emissions. Something I wanted to ask you about, you recently sent out a blog about why the EU ETS is the best regulated and best mandatory market currently. And I wonder if you could just talk about that a little bit.
Yeah, so it's been going for just over 15 years, and it's had a lot of time to kind of iterate and find out what went wrong, and try and improve that over time. So it's gone through a number of phases. I think it's in the fourth phase now, going through over the next, through the 2020s. So it covers I think it's about 40% of total emissions within the European Union. And that's going to be expanded over the next few years, while shipping, transport, and other parts of the economy are included as well. But I think more broadly, I think they've approached it from very much a market-based system. So it doesn't have a minimum price or a maximum price by which the price of emission allowances will range. They've left it really up to the market to decide what the correct approach is, and that's really why I think it's the best market, and I think we'll probably see the best outcomes from it from a climate perspective going into the future. Because unless you've got the market deciding what the actual right price of carbon is, you are likely to get resources are going to be misallocated. Investments will people might invest in the wrong thing, so I think that's possibly a lesson for other emissions trading schemes around the world, particularly perhaps those in North America, to hopefully look at what's going on in the European market and take advantage of some of those trends.
Yeah, and you've mentioned that the UK market could actually be a good indicator for global markets.
Yeah, or certainly for what the European market could do. The UK left Europe, and the European Union set up its own emissions trading scheme. So by its very nature, it's much smaller in terms of emissions, but it's because there's an additional carbon price outside of the emissions trading scheme that is on top of the price they pay. Companies in the UK are already paying, I think, roughly sort of 15 to 20 euros per ton more than what companies in Europe are paying. So if the UK is happy, companies are content. They're not complaining to their politicians about the high price of carbon. I think that is quite a good indicator that companies in Europe are probably not going to be complaining as well. So it really kind of gives confidence that we're unlikely to see any major changes in Europe that water down the rules.
Yeah, that's interesting. It's obviously then in the UK, it's at a sustainable price, even though it's 15 or 20 euros, as you say, higher than the EU ETS. I wonder if that has something to do with the strength of the UK's economy, because it's just one little strong country, and in the EU, maybe it'd be more difficult for some of the smaller countries to keep up.
Yeah, I think it's partly because of the it's a relatively small amount is traded, so it's less liquid in terms of the market, and so you are getting kind of a wider spread in terms of prices that are being offered, and that's partly resulting in that higher price. But also, the UK has kind of got a slightly more kind of aggressive target in terms of emissions reductions as well. So I think that's probably filtering into the price that the UK does deserve a higher price based on the rules that it's set.
Yeah. So one thing that I wanted to bring up with you, when I first started looking into carbon credits, for me, it was back just recently in last June, and it was a podcast with Marin Katusa. I don't know if you've seen any of his stuff, but he was talking a lot about cost of capital and green bonds and companies that are going to start buying offsets so they can fall into an ESG rating, which they can then get cheaper debt. So I wonder if you could, where do you think that's going to go?
Yeah, so I think that's right in terms of that. Companies are increasingly being rated on their ESG credentials, and I'm not necessarily familiar too much about whether the green bonds or any other kind of finance take account of what carbon credits a company has. I just come back to that perhaps sort of cautionary note I mentioned earlier on, that if a bank or other investor doesn't know the quality of those carbon credits, then potentially they could be taking on more risk if that company feels that they've offset their contribution. We're not going to actually bother doing anything with our own operations. We're just going to carry on as before because we've paid that offset. And so potentially it opens up a whole can of worms where these companies think they might be getting, we've done all our bit, we can get a better, cheaper finance, but actually the risks to the financial institution have actually gone up. So it's I think it's probably early days. I can see where he's coming from, but I think it's just how is it approached? Is it properly audited? And I guess that point and the earlier points I've made kind of come back to, I think, where I think the opportunities are really for investors in this sort of voluntary space, and that's probably the kind of more the sort of picks and shovels of how this space could develop, because it's still at such a very early stage. And so I think maybe companies that are looking to develop exchanges on carbon neutral commodities, I mentioned that LNG earlier on, or companies that are looking to almost like a sort of ratings agencies of carbon credits that can actually go through them line by line and then stamp whatever kind of rating on that particular project. I think that's probably where the opportunities are going to be.
That's interesting. I know there are some blockchain companies that are working on creating a blockchain for carbon credits, and then I'm assuming somebody like Vera or one of the authenticators would add them to the blockchain.
Yeah, potentially. I think there's companies, I think it's Avax Technologies based in Singapore that's a kind of an exchange for carbon neutral commodities. And then I think you mentioned, in terms of sort of blockchain solutions, I think there seems to be an announcement every day of a new company that's trying to kind of go into that space. So I think I can see where the potential is, but I think we just, I guess I'm just a little bit concerned that we're adding an extra layer of complexity on something that's already very complex, and that that might mask all manner of low quality projects within that, whatever that's that solution is trying to package up. So it's early days, but it's going to be interesting to see how that develops.
Yeah, and even for people who are in the space, they're generally kind of wondering, like, how am I going to get exposure? What's the best credits? As you say, sometimes they can say they're good and then they turn out not so good. So I wonder if you could talk a little bit about a few options that investors could have if they believe in the carbon industry and they think that they can see prices rise.
Yeah, so I mean, from in terms of the voluntary market, for the reasons that I've described, there isn't really a way to play the actual value of those voluntary carbon credits. Well, I mean, I guess that's not strictly true. There are kind of sort of carbon streaming companies that kind of package up these, carbon offset projects and enable them, that to be sold to corporates around the world that are looking to, meet their net zero contributions. So, I mean, that is an option, but I guess investors need to be aware that, there's that underlying risk of what actually is being sold. But I think a purer way of playing an actual rise in the price of carbon, if you believe that governments are committed to meeting net zero agendas, decarbonising their economies, then the purest way of playing that is to really invest in one of the formal compliance schemes. Either the EU ETS is as I mentioned is what I believe is the best and most well regulated one in the world. Also with the best kind of upside potential. But there's also markets like, as you mentioned, the California and Quebec market where investors can access. And then there's other markets around the world that are catering to more kind of a sort of domestic or regional audience. So there's a market in South Korea that I think is open to investors there, and also New Zealand as well. There's a carbon fund that's related to their emissions trading scheme, which I think is only open to residents of New Zealand. So there's lots of different options, but I think it comes down to what you're actually trying to play in this market. Is it the rise in the price, or is it the potential growth in the voluntary carbon market?
Yeah, and how, for me personally, I've got exposure to EUAs through KRBN, the ETF. That's the CraneShares Global Carbon ETF. But there are other options out there. I wonder if you could just talk a little bit about ways that people can actually technically go through the motion of investing.
Yeah, so the KRBN fund you mentioned, invests in carbon futures. It's a basket of carbon futures across different exchanges. I think around 2/3 is EU ETS, maybe 20% is the California Quebec market, and then there's a few other bits in there as well. But there's also supplied by or provided by CraneShares as an EU ETS specific market. In comparison to the KRBN market, it's absolutely tiny. So liquidity in that market might be quite difficult. If you're just looking at it as a sort of short-term investment. There's a company based in the UK or listed on the UK London Stock Exchange, which allows investors to access physical carbon allowances. So the most ways you can get access to it is via futures, but this company actually means you can access the physical allowances, and by buying those allowances, you're actually taking them off the market. So you're actually helping to create that scarcity of allowances, which should push up the price. And then some of the other markets, there's or products, there's the GRN product, which I think I'm right in saying it's more of a kind of an exchange traded note. So it's kind of you've got potential other risks involved, from a counterparty risk that investors need to take account of as well. And then I guess the final one, which, because I'm based in the UK, and it's a market that I can access, is the spread betting market. And so some of your listeners might not be too familiar with spread betting, but it really allows investors to basically access lots of different futures markets by placing almost like a bet, say $100 or €100 per movement in the actual price. So what it allows you to do is it's almost like a leveraged product. So you don't actually have to put down the full amount, as if you were actually investing in the market. And then from the perspective of a UK resident, it's tax free as well. So that's another upside.
That's always an added bonus.
Yeah, absolutely. Yeah.
One thing that I'm still a little bit confused about is when you talk about the physical carbon allowances. So far, the only way that I've been able to get exposures through futures with the ETF KRBN. And I know that lots of these markets, you have to be accredited investors to get into them, is the way that I understand it. Because China has their own ETS, but they're only letting in so many people. So it's not like I can go buy a China future credit right now. So when you buy a physical carbon allowance, it just gets erased, or can you send it back into the market?
Yeah, so the name of the company that provides that product escapes me at the moment, but there's a in the EU market, there's a total number of allowances that are potentially available to emitters that need that allowance to meet their obligations. So if you've bought it and you've taken it off the market, it's not available for them to use, which means that they're fighting over what's remaining. So that potentially could help push up the price. But then, as you say, when you actually sell that, if you come to the point where you're selling that physical allowance back into the market, that increases the supply at some point in the future. So what we're saying is it's not just investors that are buying these physical allowances and banking them for the future. It's utilities, it's obligated industries, industrial companies that are saying the carbon price is going to go up in the future. The scheme is getting the balance is getting tighter and tighter in the future. Carbon prices are very likely to go up in the future. The best thing we can do to hedge that exposure is to buy the physical allowance, keep it on our balance sheet, and then it's there for the future should we need it. And if not, the price should be higher in the future.
Yeah, and something that I found really interesting was that every ETS has its own kind of rules that they play by, and that's obviously where some of the confusion comes from. But what I've noticed is that certain ETS systems allow for the banking of credits indefinitely, like the EU ETS. But then other ETS systems, they say you've only got 8 years to use it. So it's kind of diminishing supply in that regard. And offsets have different timelines as well. So, I mean, it's really interesting in those markets to kind of try to navigate. And I think that's maybe why the EU ETS is doing so well. We're almost at 90 euros today. I don't know.
That's right.
I don't know if maybe you have something to say about that or the banking periods.
So it goes back to my earlier point, I think, in terms of companies can if you can bank them and hold them for a long period of time, you can hedge that future exposure. And from the point of view of decarbonising your economy, that gives investors confidence that they've either hedged their exposure or and that then they can actually put that on their balance sheet. Can show that to investors. They can then invest to help decarbonise their company and the broader economy. So I think there's a real benefit to having that ability in place. But then from, as you say, from an an individual investor perspective, you need to be clear about what markets have that ability and how different investors might react to different things happening in the market. So for example, in the California market, there's a kind of a suspicion really that there's more allowances available in the market than the total ambition in terms of emissions cuts all the way through to 2030. So what this means is that you could get to 2030 and companies within the schemes, within the California scheme, have done absolutely nothing to meet their obligations. But all they do is just decide, here's our emission allowances. We've met our obligation because we've got these emission allowances. But what I think potentially will happen is companies and investors have confidence that the price can only go up, and that confidence has to come from government that the rules aren't suddenly going to change. This is a long-term commitment. Then what they'll do is they'll hold those allowances on their balance sheet, and that will just help drive the price up, and it will just help incentivize decarbonisation as well. So there's lots of different things going on. Different markets have different rules, floor price, ceiling prices, which people need to be aware of. So it's not just a case of the price can go 2, 3, 4 times higher. There are other things to take account of in different markets.
Absolutely. So before I let you go, a lot of my viewers or listeners, not that I have very many, but the ones that I do have, we generally like to talk about energy. So I wonder if we could just talk a little bit about coal, fossil fuels. I know there's been some people see the reduction in coal power as a headwind for carbon credits because they'll say, well, if they're not burning fossil fuels, we don't need the credits. But then, the government also has the option to discard those credits and not release them into the market. So I wonder if we could talk a little bit about energy and where that's going, how it might affect carbon pricing.
Yeah, so I mean, I can talk about the experience in Europe is that went through the winter with natural gas stocks at very low levels for this time of year. Natural gas prices were really high, coal prices were high, but yet there was still an incentive for power generators in Germany and Poland and elsewhere in Eastern Europe to still burn coal, even despite the relatively high carbon price. So I think even though the carbon price and other climate policies are trying to get rid of thermal coal, I think it's very unlikely that it's going to get rid of it completely. If you look at countries in Eastern Europe, there's a geopolitical context to consider as well. They're trying not to be too reliant on natural gas from Russia. There's a domestic policy agenda as well. A lot of different regions are still very much, the employment is still very much focused on coal. So they don't necessarily want to, get rid of those industries. It's very, very politically difficult to do. So I think there'll always be a place for the fossil fuels, even coal for some time. And then, as we're trying to move towards a zero carbon economy, there's this whole argument about the role of natural gas in enabling that transition. So I think even the experience over the last year, and I think what we'll probably see over the next decade, is that that's going to be a very turbulent, volatile period. As the supply chains develop and change and morph. We've had well over 100 years to form the economy that we're in at the moment, and we're trying to completely rip it up, change it, move to a completely different alternative energy source, which is less dense, much more, moving from a kind of an iterative process that's developed over a time to a kind of state mandated energy source that's we're trying to introduce over a certain fixed time period in order to meet our climate ambitions. So that is going to be very disruptive to energy markets, but it's also going to be disruptive to carbon markets as well, both on in terms of higher prices, but also volatility as that market develops as well. I think it's going to be very interesting in the next 10 years, but there's also going to be lots of opportunities in different markets as well.
Yeah, I think with that volatility probably will come some opportunities. Last question before you go, something that I've really kind of struggled with is that a lot of people talk about the relation between natural gas and carbon price. And for me, I'm always kind of like, why is there such a, push pull with those prices? Is it because as natural gas increases, it incentivizes fossil fuels because it's cheaper, or what do you think is going on there?
Yeah, so That's right. So higher natural gas prices relative to coal, that encourages generators to switch to the relatively cheap or relatively inexpensive, thermal coal. But that, of course, has a carbon price, a higher carbon cost attached to it as well. And so there's that dynamic working as well. And also, there's various interactions between the actual power price. So if power prices go up, that sometimes incentivizes generators to pay to buy carbon allowances when they can, because they've got that additional margin as well. So there's lots of different dynamics going on that alter the relative price of carbon. But I think the point to be made about that there is, we've seen the EU ETS and other carbon markets have been very successful in that kind of coal to gas switching. There's still that element of it left, but the market is increasingly moving towards what's on the horizon. So it's not that coal to gas switching, it's the industrial decarbonisation, and that's the sort of bigger impact that's affecting the overall carbon market. Because the carbon price could be a hell of a lot higher than that.
Awesome. Yeah, there's certainly a lot to talk about, and there's so many moving pieces, and it's so new that for me, it's a very exciting space. So thanks for coming on. If you want to just go ahead and let anybody know where they can find your products. And
the best place to find me either is on Substack, that's Carbon Risk, or on Twitter, it's at Peter Sainsbury 7, or Carbon Risk _. And there you can find all links to all different books and other products as well.
Awesome. Well, I'm definitely a subscriber and will continue to be. And I'll look into those books as well. So thanks for coming on. Appreciate it.
Cool. Thanks very much.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.